If you want to truly capitalize on the potential of small investments, recognizing and avoiding these pitfalls is just as important as finding the right stocks to begin with. Now, what does the right approach look like? Before you invest a penny, know what you're looking for. Maybe you're focusing on companies with at least 20% annual revenue growth, positive cash flow, and low debt. Maybe you want companies that operate in secular growth industries, areas that are likely to expand for decades, like renewable energy, advanced healthcare, or cloud computing. The point is to have a checklist. Even 30 minutes of solid research can give you a sense of a company's fundamentals. Skim an investor presentation, read an earnings report summary, or look at a quick stock analysis from a reputable source. You are not aiming to become a full time analyst. You just want a rough but solid understanding of what drives this company's growth. Start with a small position. There's no need to go all in. Over time, watch how the company performs. Are they hitting their growth targets? Are they beating analyst expectations? If things look good, you can add to your position. If not, you can sell and move on, having lost only a small amount. If you identify three or four promising companies and invest small amounts in each, you're spreading your risk. If one doesn't pan out, you have others that might overdeliver. This approach balances risk and reward. When you follow a disciplined, research driven approach, you start building a track record of successful small investments. Each win boosts your portfolio and your confidence. Over time, you might become better at spotting these opportunities and more comfortable committing slightly larger amounts. This is how you gradually scale your success. Instead of making a single large bet and hoping for a jackpot, you're building a repeatable system that can yield multiple wins over the years. Another critical benefit is peace of mind. Know you invested based on solid reasoning, not rumors or fear of missing out, helps you sleep better at night. This stability is important for someone who has a demanding job and cannot monitor the market 24/7. You have a plan, a rationale, and you trust your process. That in itself is a competitive advantage. One of the best things about small investments with high potential returns is the long term compounding effect. If you repeatedly find opportunities that outperform the S&P 500, even by a few percentage points per year, the difference in your portfolio's value over a decade can be staggering. Think about it. If the S&P 500 averages 10% annually and you manage 15%, that 5% difference compounded over 10 or 20 years can significantly outperform a passive index approach. It means retiring earlier, achieving financial independence sooner, or having more resources to invest in your passions.